Good afternoon, everyone, and welcome into the Wolf Financial Live Show. I'm your host, Gav Blacksburg, as always. And joining me today, Taylor Rainey from the REXShares team. So excited to have you on. There is a lot to discuss here in terms of the market, option strategies, ETFs, and so much more. Welcome to the show.
Thanks for having me. Excited to talk to you guys again. It's good to meet you first face to face here.
Yeah, absolutely. It's going to be a great conversation. We've been doing stuff together with Rex for years at this point, mainly talking with Scott, but great to have some fresh faces on the show. So let's get right into it and talking about really these new investment products that people are able to check out now. You guys have launched a ton of new ETFs over the past year, and there's been a real draw to these single stock option-based income ETFs. There's also some auto callable ETF that we're going to talk about a little bit later, but let's just start with kind of this overview of the lineup here of these option-based income products and why you think they're so attractive to retail investors right now. We've seen a ton of AUM being driven towards them over the past year, especially with the current market conditions, and then we'll take it from there.
Yeah, sure. Happy to. Rex certainly has a lot of different options out there, and not to make a corny pun, but when it comes to alternative income nowadays, we launched the Auto Callable Income ETF yesterday, so really excited to kind of expand that alternative income lineup. I'd say if I think about breaking down what our offering really has, we have our core concentrated covered call kind of basketed options. So that's FEPI, AIPI, and CEPI. That takes a different approach than what everybody else in the marketplace, for the most part, has out there. They're all writing on index levels. We're writing on individual securities, right? So you guys, I think, are pretty familiar with those strategies. FEPI's 15 US tech stocks, all equally weighted. There's a pretty beneficial relationship that we've been able to take advantage of between the premium that you can collect and the level of implied vol. So fundamentally, that's how we've designed those strategies. On the single stock covered call side, when we went through that process, there are a lot of different ways to approach that. But what we did is we back tested a lot of different levels of leverage. So the structure that we have implemented is a 1.25 levered underlying exposure. It's all synthetic. And then we cover half the portfolio. So in effect, you have 62.5% covered, which means, or uncovered rather. So covered and uncovered. What that does is really allows you to A, recover when NAV sells off, and B, just participate in rallies more efficiently. Now, when we did this, we back tested everything from a Delta 1 strategy all the way up to 1.5 times leverage. And we found that 1.25 is really a sweet spot where, from a total return perspective, you were able to capture something very similar to the underlying exposure, just with a different return composition. Now we're producing weekly income from that. Except, now instead of having these big tech stocks where you're just really getting price return, with this, you're pulling out a pretty heavy yield. Looking at things like Tesla and NVIDIA with TSII, NVII, been able to, since launch, outperform the underlying exposure from a total returns perspective. So very excited to see how that works. So, right, concentrated basketed portfolios. We have individual covered calls, single stock covered calls. We have 9 at this point in time. I know people keep asking for a fund to funds version. As I always say on these things, we take client feedback seriously. So always, continue to keep an eye out and see what we're up to. And then the auto callable space is newer. So we've seen a lot of press around this, and not only just press, but a lot of action from ETF issuers. And so this whole derivative income space 6 years ago was almost non-existent in the ETF structure. You've seen buffered explode hundreds of billions of dollars across all of these different categories, and auto callables are kind of the newest one. And we came out with a pretty innovative approach to this where we have daily laddered exposure. So we're adding a new auto callable exposure every single day. And if you know about structured notes, they're very endpoint sensitive, depending on the market environment you launch it in, the barriers that you have. So what this does is really smooth out that return profile and afford a generally smoother ride for clients. So across the board, what we're doing with auto callable, we've constructed that more of a spread product from an income perspective. So we're targeting 10% plus SOFR. So that will dial up and down moderately depending on what's happening with rates. FEPI 25%, AIPI 35%, CEPI 42%. So from the basketed, pretty strong, pretty solid. We're collecting more premium than we're distributing out. And then the single stocks, again, it's designed to give you access with a different return composition. So I'll pause there.
Yeah.
We can move on to the next.
Yeah, well, I definitely want to dig into a lot of this. I can tell that this is your area of expertise. That's pretty easy to see. Before we do go a little bit further, also want to mention to the audience a quick disclosure here and also a shout out. This live stream, doing this one in tandem with NASDAQ, actually, which is super exciting. So this is done with REXShares, but also helped to facilitate by NASDAQ. And from a disclosure perspective as well, because we are talking about investable products here, all investors, please make sure that prior to investing in anything, that you carefully consider the fund's investment objectives, risks, charges, and expenses prior to investing. If you want to find that, is all the fund's prospectus, the summary prospectus can all be found right on the REXShares website. And to obtain the fund's prospectus or summary prospectus, again, just go right to the website. You can download it, and you should read it carefully prior to investing in anything. So I wanted to put that out there. And we've worked together with REXShares for years. But obviously, of course, it's always good to disclose to the audience that we are paid partners together with this. So let's dive a little bit deeper into a few of those topics which you were touching on. I think one thing which really gets talked about a lot is NAV, right? And NAV erosion and pieces like that. And it seems to be like one of the number one things that retail investors gravitate towards when they're examining these different products and seeing, hey, which firm is really approaching this best. And you mentioned, really trying to not, erode the NAV, but instead make sure that the way you're running this is you are collecting significant amounts of premium and then paying out that premium, but not paying out, more premium than you're collecting to them, which would eventually, be kind of like determining the fund's downward arc. So I'm curious if you can speak a little bit more towards that, and then just anything else that you're really hearing from retail investors.
Yeah, so if we're talking about the covered call strategies, there's a difference in how all these are constructed, and it's you kind of laugh working in this industry because compliance is so strict, and I understand the reasons why. And what you're saying is exactly true. And I talk to clients all the time about this. It's actually really important to think about all of the ins and outs of the different strategies that you are investing in. And when it comes to NAV, that's really important with these strategies. Over the last 12 months, we've seen a lot of different market environments, right? So February 18th last year was sort of the peak before the big sell-off. That went until April 8th. FEPI, as an example, was down 23%. It's a pretty significant drawdown. You compare that to some of the other strategies that write on the index level, there's a little bit less vol involved in those. So their NAV depreciated a little bit less than ours had. But the way that we construct that portfolio is by writing 5 to 10% out of the money. And so when you look at the ensuing recovery, which was NASDAQ up 45, 50% from April 8th to something like October 29th, FEPI was able to keep pace with NASDAQ. I think we actually outperformed the Qs by a couple of basis points during that specific period, outperforming some of the bigger players by 12%, 25%. And so when you think about NAV, it's a dynamic relationship where you have to look at these different periods, and you can't just consider what happened over the last 2 months. It's really important to know because then you have expectations going forward. But, for instance, since that kind of October 29th, October 30th period, which was arguably a more recent peak, we've seen massive individual stock dispersion across U.S. equities in general. While our approach of writing on individual securities has a lot of benefits, that's a period where we potentially are going to underperform. And that's something like where, last I cut the data, or maybe at the end of January, Micron was up over 80% in that specific environment. Right. Unfortunately, when that happens, when we're writing on individual securities, we're not capturing that 80%. We are capturing the names that are down. And so when you look over that entire period, you have a pretty sharp drawdown in the beginning of last year. You have a really strong rally after that. So maybe we underperform a little bit in the drawdown. We outperform substantially during the ensuing recovery. And then this next period is one of more stock dispersion, where it really depends on security selection at that point. And so to your point, understanding the investments that you're actually allocating to is incredibly important. We don't have, with those strategies, a portfolio manager saying this is the best stock that we need to own. It's all index driven. The goal here is to make sure that you guys are consistently having exposure to the largest and most liquid US technology stocks. It's rebalanced monthly. It is reconstituted quarterly. That just means names are going to come in and come out of the portfolio at that point. And so again, it's really kind of that classic look across an entire full market cycle to see what you're getting exposure to. But NAV erosion, NAV growth, when you're distributing 25, 35, 40+%, some funds out there, 80, 100, that's naturally going to happen in certain cases. It's how you've structured your portfolio to be able to address that across all of these different market environments. So if I then kind of transition that to the single stock covered call strategies that we have, right? So I'm just kind of looking at NVIDIA and Tesla are two great examples of how that structure has worked really well. You've had since we launched in the summertime, relatively strong up market, maybe some sideways markets in that. We are harvesting volatility through option premium. We're participating in the upside. We're outperforming the underlying exposures of Tesla and NVIDIA.
That's the goal, right? That's the key.
Exactly. If we can do that over time, we're not only just giving you the same return profile, but then we're enhancing it and we're adding your income for you. You look at something like MicroStrategy, which 2 years ago was high flying, more recently struggling. In looking at that, we're MSII is down 69% total return. It's not awesome, right? You don't want to see that. MSTR is down 67, right? So even with that 1.25 times leverage on the downside scenario, this is kind of the worst case scenario. You don't want to see this. We're keeping pace with the underlying exposure. So based on our structure, we're not hurting investors necessarily in this with that extra leverage. Where you do see some challenges with that type of structure is what happened with COII, our Coinbase fund. And that was in the early days where you had an up day of coin. I think it was something like 15+%. When you're writing weekly options, if that happens within a week, you're not capturing the full upside there. That happened 2 weeks in a row. And then a month later, we had like a 15, 20% drawdown. So then you're levered on the downside. So this is kind of that catch-22. The enhanced volatility is what gets us higher premiums. But in those types of really choppy, really drastic far moves, it can become challenging. Again, this is kind of going back to your point. It's important to understand what you're investing in so that you have some idea of what expectations are. So from a NAV perspective, we haven't really seen NAV erosion relative to the underlying index with these single stock covered call strategies yet. They've all kind of kept pace to some degree with the underlying exposure. So we're happy to see that for sure.
Yeah, that's always the goal. If you can outperform, even better, right? With those single stock covered call style ones. I'm curious, you talk about listening to retail. What do you think retail wants next? Like, where do you see them gravitating towards? What are the things they want to see you add in name wise or details?
Yeah. Look, and I'm not trying to put words in anybody's mouth, but watching this market and watching retail over the last 2+ years, I think there's been a massive educational shift where retail's gotten really smart about a lot of these strategies. And so there was a point where, 150% annualized distribution rates, everybody's like, yeah, this is the best thing ever. I want this. I want this. I want this. And now all of a sudden it's all right. Well, let's moderate that a little bit. The NAV component comes in a lot. And I'd be curious to hear your perspective on that as well. But it seems that that's moderated a little bit to balance both growth and income, which is exactly what we're trying to solve with these products.
Yeah, exactly. When people first were looking at it, I don't know if they fully understood the underlying mechanisms or an understanding. And to be honest, I think most retail investors are probably using, a platform like Robinhood where it doesn't really show it accurately, right? You kind of have to scroll down to the bottom and be like, okay, what's the actual return, right? It's not really reflected typically in the chart properly. And so I think that people were just gravitating towards large payouts, right? And that's what they were seeing. And they were seeing other people post large payouts, right? It's in screenshots of them. And look, I'm holding this. And so you had a swarm towards it. And then absolutely, you've seen an era of moderation happen as you have a lot of people, including ourselves, that are covering this actively on a weekly basis and showing people, hey, like maybe your money is better off in, not as high yielding, but stable, right? I think is that the word, right? That people are looking for something that's more stable for the long term. And so people have definitely gravitated towards it. And I still think that there's a lot of confusion, to be honest, and maybe you can clear it up. Like people are like, okay, well, like, do I just want like plus 10, 15%? Like, is that a good area? Should we be striving for 30? Like, where does it become too much? I don't think people really fully understand the range and how it correlates.
Yeah. It's really difficult to say because of the different structures. You're not going to get 25+% writing on an index level. if you are, it's a really volatile index. I mean, you could, it's just not going to be the S&P or NASDAQ.
Right.
I think it's interesting watching, you take retail on one side and you take like the financial advisor institutional community on the other end, and they're kind of converging. And that's where, FEPI in particular has always been in this sweet spot where you've got the super high yielding on one end of the spectrum, which drew in retail early. And then you've got the JP Morgans and the Goldmans of the world who had the kind of boilerplate, exactly what you'd expect. They're writing calls on the S&P 500 or NASDAQ 100, and that was getting you 8-12% in distribution rates. You start getting something in the middle there. And then all of a sudden, the financial advisor community and the institutional community looks at that and says, oh, wait a minute, there's nothing funny going on here. You own 15 stocks and you're writing on those individual names. That's how much premium you actually collect. So they start getting comfortable with that idea. And so it starts to moderate in that, with FEPI, and I continue to use that as an example because I think it's a sector that everybody looks to. It's a sector everybody's invested in. And it contains kind of the Mag 7 Plus or FANG and Friends. And so that we launched with a NAV of 50 or so. It's gone down into the 30s. It's gone back up, kissed 50 again. And now it's back in the 41, 42 range because of some of that individual security dispersion I was talking about and market sell-off in November. So with that, it depends on the market environment. I think when you start getting into the 20s and 30s, you start introducing more of that risk. You start getting in the 40s, 50s, it becomes a lot more difficult to be able to maintain NAV and grow with that.
So probably not a lot of financial advisors gravitating towards those. If they're going to have something like this, they're going for those lower risk areas, you think?
I think that's where they started. I think they're starting to get more comfortable. I mean, I have conversations with a lot of those folks on a regular basis who get comfortable with, very comfortable with a 25% distribution rate. But you also have to understand that these people are really focused on risk management. They're coming out of the 2010s and doing this professionally, where it was really difficult with a multi-asset portfolio to get 4 or 5% without eroding NAV. And so you throw something like even 15% and it becomes really, really hard for them to wrap their head around. You can get them there. It's an educational, experience, the same as any.
Right.
But no, I mean, I don't know. Personally, I look at the performance there and it's exactly what I would expect it to be. And I think that's the most important thing. If you're comfortable with NAV going down 5, 10, 15%, but you've captured 25% a year, it's pretty strong value proposition in my mind. But no, I mean, it's really, really hard to say what that sweet spot is, because that brings into consideration coverage ratios. Do you have a static coverage ratio? Are you dynamic? If you are dynamic, are you doing that based on, historical realized vol? There's a relationship in the volatility risk premium between implied and realized. And, it takes a really complex formula to really dial that in. And look, when we talk about these products, simplicity is of the utmost importance, because you could have the best product in the world, but if nobody understands it, then nobody can get behind it and they can't get comfortable with it. So there is a balance there. And that's why I love the way that we structure these portfolios. It's 15 or 25 names that all of them. You probably own in some other part of your portfolio. And they don't really pay dividends. So now you're getting a different return stream.
With the financial advisors, I know a lot of them over the last couple of years have gravitated towards some international exposure to help diversify some of their clients' portfolios. Do you guys have stuff like this kind of on maybe more international exposure type names, or thought about like taking like more of like an international index and running something on top of it?
Definitely had conversations. I think it becomes a little bit different. The option market in the US is a lot deeper and more robust than it is in Europe. So depending on how you're looking to approach that, it might make sense to do that on an index basis. There's timing considerations as well. Not to get into, details or the weeds, but, if that's something that you find people are asking for, it's certainly something that we would, potentially expedite conversations and figure out internally. We do have products available to the European marketplace, but it's the same kind of US based products.
Yeah, no, it makes sense. It's just something that I've been looking at. It's an area that I've been gravitating towards as, some might say there's a little bit less confidence in the US and
Yeah.
the dollar than there has been in past years. And so it's just something that I've been kind of stocking up on. I want to make sure that we touch back real quick on that first auto callable ETF that you guys launched. You briefly mentioned it towards the start. For my audience that's just unfamiliar with auto callable ETFs, maybe you could give a little bit more depth to that and talk to, what's coming up after this one.
Yeah, so again, very excited. This was in the works. A lot of hands in this to get this to market. You've seen some other major players bring these products to market, both in a basketed format as well as in single stock at this point. What we decided to do with this, and I guess I could, step back and what is an auto callable? It's essentially exposure, and you're really kind of trying to take equity volatility to create a return stream or an income stream. So in a similar way that you do with covered calls, right, you're harvesting volatility. You're doing that just in a different way. So with this strategy, we use the Bloomberg US Vol Max Index, which can have a leverage factor between 1x and 5x. So as you can imagine, if that's on the B500, essentially, that can be a very volatile portfolio. But what an auto callable is you basically say you have a coupon barrier, you have a principal barrier, and you have a call barrier. And so usually, and with this, all of our underlying exposure has a 1-year non-call period. So you will collect coupon during that period. After that, if it's above 100% of the index level, so where it launched, that note is going to get called. And then you have to redeploy that capital. So if you think about doing this mechanically as a financial advisor, then that becomes really difficult. You're left with a pile of cash that you have to redeploy at different terms. And so doing this in a diversified basket with an ETF, I mentioned earlier, we are adding a new auto callable exposure on a daily basis. So that's diversifying your endpoint and your starting point risk. So the level of volatility that you are exposed to with each individual note is different. And so if one of those notes get called within the portfolio at any given time, we're going to have 252 to 1,260 notes. The other pieces of this are a coupon barrier. And so as long as that reference index is above that, so for us, that's 40% down, the reference index has to be. On a monthly basis, you'll get your coupon. And then at maturity, which is 5 years, which would mean that the underlying reference index has been negative over a 5-year period with equities that's very low likelihood, but still possible. The note would have to be below 50%, or the reference index would have to be down 50% or more at maturity for you to actually experience impairment. Otherwise, you receive par. So it kind of operates like a fixed income instrument. It kind of operates like an equity instrument. In the ETF, it's a diversified basket. It smooths your return streams, diversifies your endpoint sensitivity when it comes to coupon payments. And it's just a different approach. And to your point earlier on what levels of income are interesting to people, we had structured this, like I mentioned, 10% plus SOFR. So a little bit of floating, but it gives you that 10%. Historically, the total return experience has been very similar to the S&P 500, just with, again, different return composition. So majority of that return coming from coupon.
What's the ticker on that?
ATCL.
Okay, ATCL. Any other tickers specifically that you think would be very interesting for retail to look into while we're on here?
That kind of covers it at this point. It's the single stock covered call. It's the auto callable notes or auto callable, not notes, ETF, as well as FEPI, AIPI, and CEPI.
Yeah, definitely encourage people to check those out. There's a picture of me somewhere repping one of the FEPI big hats.
Nice.
That were making their way around, and I was at the bell ringing as well at the NASDAQ, I believe, when maybe this hit 500 million in AUM or something along those lines. But yeah, something for people to go look at. And again, make sure if you are looking at it that you actually look at, the percent price return, the NAV return, those details as well. So those are really important to look at for the overall piece of this. Now, I do know that you had a couple of slides. Would you have interest in sharing them real quick, walking through anything on there, or do you want to keep it to the top?
Well, hold off just because timing, as well as I pretty much have covered all of the points that would have been on slides. What I do want to mention, though, if you don't mind, is just on it's tax season. We've been getting a lot of inquiries when it comes to option-based strategies. Sometimes 1099s get delayed just because you have one of those types of strategies. And for those who are listening, who are invested, first of all, thank you for being big supporters for us. Second of all, I just want to provide a little bit of clarity here. At this point, for FEPI and AIPI, there is an extension in place for the 1099s. Brokers will sometimes put out placeholders. And so my personal holdings, for instance, show that I have 100% non-qualified or ordinary income. That is not something that was officially put out. It's a placeholder in that capacity. So again, not tax advice. Please discuss with your financial advisor. Please discuss with an actual tax professional. But I wanted to give a little bit of color because we've been getting a lot of inquiries. We're working internally to make sure that that is available, the finalized version, as soon as possible. But kind of a public statement there.
Cool. Yeah, that makes sense. I think that's good to hit on. And then also one thing that we just kind of lightly touched on was, different option structures operating in different market conditions. And we've had several different types of market conditions. We've kind of had a roaring bull market the last 3 years. One would say, a bear market the year before that. This year starting out kind of interesting, a little bit mixed. So just curious if you could walk through how they work in different markets.
Yeah. So, I mean, I kind of covered a little bit of this with our strategies. And if you know me, I'm one who's not going to say anything bad about anybody else's strategies because I think a lot of the time they all work well in different environments. And so as I mentioned, right, if I look at the end of October through now, where you have stock dispersion, index-based strategies tend to do better in a lot of cases. And this again just depends on security selection. But if you think about that, if you've got something up 80, you've got something down 30, and then you have an index version of that. Maybe you're around 0, maybe you're around 10. I'm not quite sure what the weighting would be. That index is going to be a lot less volatile in nature. And so if you think about different strategies out there, you have some who have a dynamic coverage ratio. You have some that write typically 80% over the portfolio. You have others that write 100, right? 100 is, Global X. Global X wasn't able to capture as much of the upside in that April to October period. But if you look at what they've been able to accomplish since October through now, they've done really well. What they do is they write on more of the portfolio. They collect a lot of premium. They keep some of that premium within the portfolio, similar to what we do. And because that's on an index level, that portfolio does pretty well in this environment, right? They're adding to NAV on a monthly basis. They're still distributing, and it's a little bit less volatile. So if you think about, that same structure, right? So those are FEPI versus a QILD as an example. In a drawdown environment, like we saw last spring, QILD is probably going to outperform. In the follow-on bull market, FEPI is going to outperform. In this dispersion market, QILD might outperform depending on security selection within FEPI, right? That can go either way, but QILD with that type of structure could be a really interesting addition. If you blend these types of exposures, then all of a sudden you have a really interesting income portfolio that can weather all of these different environments, and you're not kind of getting hit over the head in one and then doing really well in the other. So that's how I think about these. It's how I allocate myself. It's how I talk to every professional investor, retail investor, is having a diversified approach, not only in the sectors that you're allocating to, the asset classes you're allocating to, but within that, the structure and how a portfolio is actually built, right? You can buy SPY and have passive S&P exposure. And then on top of that, if you want some really high conviction, equity analyst ETF, they have those now, right? High active share. You overlay that and you get a little bit of kind of active flair within that portfolio. So just kind of my 2 cents on how to think about portfolio construction and diversifying your portfolio.
Yeah, really nice way to be able to make a combo mix inside of the portfolio that gives you, exposure to the underlying asset that you want, but spices it up a little bit for different market environments. Very well said. I really enjoyed the conversation. I think it was a bit technical, but very helpful for people that were in this area, right? Who are trying to understand this. It's a great breakdown for them. Where would you recommend people go to find more educational information or really to understand and learn the depths of this?
Yeah, so, REXShares.com. You go to the covered call section, now the new ATCL for auto call section as well. We put a paper up under, I want to say it's insights or news on our website that was analyzing that April to October period and emphasizing the importance of out of the moneyness. So any of that type of information would live there on our website. If not, reach out directly on our website. It will probably get routed to me or one of my colleagues, and happy to have a conversation and dive into depth or try and oversimplify it, right? So depending on your level of knowledge, what you're looking to understand, we're here to be the educators as much as we can.
Fantastic. And then any final comments for the audience today before we close out this stream?
No, I just want to thank you and thank everybody who's listening. Thank everybody who's supporting our products. And as we continue down the auto callable path, looking forward to getting that to both retail and the institutional community. It's one of those products that I think is going to fit really nicely for all walks of life.
Yeah, really brand new. People can go look and see that this literally just launched yesterday. So it's going to be fresh on the screen. So make sure you add it to that watch list. Thank you to everyone that tuned in. Thank you to NASDAQ for helping to coordinate and set this up, as well as the entire Rex team, and of course yourself, Taylor. Appreciate everyone who watches our shows. Like you mentioned, there's a lot more educational material, as well as the funds prospectus and summary prospectus on REXShares.com. So go ahead and check that out. This has been live streamed on both the Wolf page and the Stock Market News page on Twitter. You can find it on either one, and a full replay will be available after we close out. Thank you everyone for watching. Wishing you a great day in the market, and we'll see you on the next show. Take care, everybody. Have a good one.